California's real estate market has come to a near standstill. 73,000 homes sit unsold. Yet buyers have all but vanished, and the dream of home ownership is slipping further away as affordability collapses. In 2025, with mortgage rates stuck above 6.8% and insurance premiums skyrocketing, even longtime residents are finding themselves locked out, trapped off, or forced to flee. This isn't just slowing down, it's a full market freeze. The one crisis almost nobody saw coming. What exactly triggered California's housing machine to seize up? And who's left carrying the cost? The unraveling begins now. 73,000 homes now crowd California's active listings, a figure not seen since the last major correction nearly a decade ago. In Los Angeles, San Diego, and Orange County, the surge is unmistakable. Rows of for-sale signs line suburban blocks, while online platforms like Zillow and the regional MLS fill with properties that linger week after week. By May 2025, inventory had more than doubled from 2 years earlier, with estate supply climbing faster than at any point since the 2008 crisis. Sellers, who once expected bidding wars, now face an audience that barely shows up. This flood of unsold homes is more than a number. Each new listing adds to a growing backlog, putting downward pressure on prices and eroding seller confidence. In some neighborhoods, the average time on market has stretched past 90 days. Agents report that price cuts, once reserved for stale listings, are now routine, with reductions of 5% or more becoming the norm. The state's median home value, up just 1.3% year over year, is slipping month by month as inventory outpaces demand. The overrun isn't limited to one region or price bracket. Luxury condos in downtown San Francisco, starter homes in the Inland Empire, and suburban tract houses in Sacramento all share the same fate. Too many listings, too few buyers. Even investor-owned properties, once snapped up in bulk, are stalling as large firms pause acquisitions and smaller landlords rethink their math. With 73,000 homes sitting idle, the risk grows that price declines will accelerate, especially if more owners are forced to sell. For buyers still in the hunt, this means more choices and stronger negotiating power, but also a market clouded by uncertainty. The numbers tell a clear story. California's real estate engine isn't just slowing, it's flooded with supply, and the pressure is building for what comes next. In California, the simple math of home ownership has turned punishing. Across the state, more than 6 out of 10 counties now demand that residents spend over a third of their income just to keep a roof overhead. In nearly 1 in 5 counties, that burden swallows half of every paycheck. For buyers over 25, the age bracket that once drove the starter home market, the numbers are especially stark. Adams' latest affordability index paints the picture. The majority of local markets are officially labeled as danger zones, where fixed costs alone push home ownership out of reach for most working families. The median home price in Southern California hovers near $800,000. Even with 20% down and a 7% mortgage, the monthly payment clears $4,300 before taxes or insurance. That's more than double what buyers faced just 5 years ago. In the Inland Empire and Central Valley, where homes once offered a path to the middle class, monthly costs have jumped by 80% since 2020. Rents have climbed, but not nearly as fast, making the buy versus rent equation even tougher to justify. For many, the dream of a first home now comes with a hard choice: stretch for a mortgage that eats up every spare dollar, or wait on the sidelines and watch prices drift. The pool of qualified buyers keeps shrinking as incomes fail to keep pace with housing costs. Agents report that buyers in their late 20s and 30s, once the engine of the market, are postponing offers, renewing leases, or leaving the state altogether. Each month, more listings pile up, but the people who can actually afford them are vanishing. The freeze isn't just about inventory or rates. It's about a generation priced out, calculating the cost of every decision and wondering if the numbers will ever add up again. State Farm's withdrawal from California's home insurance market in May 2023 sent a shockwave through the state's real estate system. Within weeks, Allstate followed, halting new homeowner policies across vast stretches of the state. For buyers trying to close on a house, insurance, once a routine step, became the single biggest barrier to finishing a deal. Escrow officers in El Dorado and Sonoma counties watched transactions collapse as buyers received quotes for $12,000 or $17,000 a year, sometimes for coverage that only protected against fire and nothing else. In the Sierra foothills, agents report that more than 1 in 5 sales now fail because buyers can't secure a policy at any price. The California Fair Plan, designed as an insurer of last resort, has ballooned from 127,000 policies in 2019 to over 350,000 by late 2024. Premiums for basic coverage now stretch from $3,200 to $7,500 a year statewide. But in high-risk zones like Malibu or Topanga, annual bills of $10,000, $15,000, even $19,000 are routine. The Fair Plan's bare-bones protection leaves gaps for water damage, theft, and liability, exposing new homeowners to risks lenders won't accept. Mortgage officers confirm a rising share of deals converting to all cash as buyers who can't secure insurance are forced to waive loan contingencies or walk away entirely. In Los Angeles County's hillside neighborhoods, the impact is especially severe. Nearly every major private insurer has redlined entire zip codes, and sellers face months of uncertainty as buyers scramble for any available coverage. According to the California Association of Realtors, 13% of agents statewide lost at least one sale to insurance issues in 2024. In almost 2/3 of those cases, the buyer simply could not find policy. For the rest, sticker shock at the quoted premium made the purchase impossible. Regulators have tried to contain the fallout, approving limited emergency surcharges and expanding Fair Plan coverage caps. But these steps have done little to slow the exodus of private insurers or the rising tide of failed escrows. Reinsurers, global firms that backstop catastrophic losses, have hiked surcharges or pulled out of California altogether, making it even harder for local carriers to stay in the market. The result, a growing class of homes that can be listed, toured, and even bid on, but not sold to anyone who needs a mortgage. In fire-prone counties, the insurance crisis is no longer a side story. It's the main reason deals die before they ever reach the closing table. 71% of California homeowners now hold mortgages locked below 4%. For these owners, the idea of selling isn't just unappealing, it's financially punishing. Before 2022, a 30-year fixed loan with a 3% rate was common. Today, the average sits at 6.82%. And for anyone considering a move, that gap has become a wall. The numbers lay out the dilemma. A homeowner with a $600,000 mortgage at 3% pays just over $2,500 a month in principal and interest. Trading that for a new loan at current rates means a jump to roughly $3,900, an extra $1,400 every month, or more than $16,000 a year for the same amount borrowed. Over 30 years, the penalty stacks up to $264,000 in additional payments. Even those with rates below 5% face a 15% increase in monthly costs if they try to buy again. Now, for most, the math simply doesn't work. This lock-in effect has frozen the market from within. Homeowners who might have traded up, downsized, or relocated are staying put. Empty nesters in the Bay Area, young families in Orange County, and retirees in Sacramento all face the same calculation. Moving means surrendering a once-in-a-generation rate. The result is a two-speed market. Those with old loans stay anchored, while new buyers face costs that have nearly doubled since 2020. Mid-tier homes now demand payments over $5,900 a month, up 82% from 5 years ago. Even entry-level buyers aren't spared. Bottom-tier homes, once the entry point for first-timers, now require $3,600 a month, an 87% jump. For buyers over 25, the group that once powered the state's housing churn, the lock-in effect has turned mobility into a luxury. Many who might otherwise buy or sell are simply frozen, waiting for a break that never seems to come. Geography sharpens the divide. In coastal counties, The penalty for moving is magnified by higher home prices and the loss of Proposition 13's property tax protections. Inland, where prices rose fastest during the pandemic, the gap between old and new payments is even wider. Transaction costs, commissions, taxes, loan fees only add to the burden, pushing many to abandon moving plans altogether. The lock-in isn't just a personal headache, it's a structural break on the entire market. Listings dry up, choices evaporate, and even as inventory climbs, much of it sits idle, priced out of reach for all but the most determined or well-heeled buyers. Until mortgage rates fall sharply or owners are forced to move by life events, the freeze will persist. For now, California's housing market remains trapped between two eras, one defined by cheap money, the other by a new, unforgiving reality. Angela Morales spent most of 2023 chasing the same dream as thousands of other first-time buyers, a starter home somewhere within reach of her job in Stockton. In May, she locked in a mortgage at 6.1% and started touring open houses. By August, rates had climbed again, forcing her to slash her budget by $60,000. Each offer she made was outbid, often by investor groups she never met. In November, her last shot fell apart when the insurer flagged the property as a fire risk and denied coverage. By January, after months of searching, Angela withdrew her final offer and renewed her lease. She's still renting, still waiting, and still watching the listings pile up. Mark Tran, a Sacramento realtor, remembers when 12 listings meant a busy season. By spring 2024, his roster had ballooned to 57 unsold homes, most sitting for more than 6 months. Price cuts, TikTok walkthroughs, and even offers to cover closing costs brought in clicks, but few serious buyers. Tran's lowest-priced homes moved, but the rest stagnated, caught between sellers unwilling to drop further and buyers paralyzed by the cost of borrowing. He spends more time managing anxious clients than negotiating deals. We're seeing price cuts of 8 to 12% now in Sacramento, and yet buyers just aren't showing up, Tran says. Investors, once the market's biggest risk takers, have pulled back. In early 2024, Blackstone's internal dashboards flagged California's inland empire as illiquid. Too many unsold homes, too much risk. The firm halted all new single-family acquisitions in the region, citing rising insurance costs and the threat of negative cash flows. Smaller landlords, squeezed by higher premiums and stagnant rents, have started to offload properties or sit on the sidelines, waiting for clarity that never comes. Builders haven't escaped unscathed. Firms that gambled on rapid sales during the pandemic boom now face rows of unsold homes and frozen financing. Corporate memos circulate quietly. Bridge loans are on hold, new projects delayed, and layoffs looming. For every house sitting empty in a new subdivision, there's a spreadsheet showing losses mounting by the week. The freeze isn't just numbers on a chart. It's real people, stalled careers, and capital in retreat. The gridlock shows no signs of clearing, even as the backlog grows. Zillow's latest report delivers the hard proof. California home values slipped 0.42% in a single month, an annualized drop of about 5%. 4 straight months of price deceleration confirm what agents and sellers already sense. This isn't a pause, it's a measurable reversal. The state's median price, once immune to correction, now bends under the weight of too much inventory and too few buyers. Sellers keep raising asking prices, but the pool of qualified buyers keeps shrinking. Each week, more homes linger unsold, and the old rules of real estate, location, timing, even curb appeal, have lost their power to move a listing. The freeze doesn't stop at the border. As California's buyers retreat and inventory piles up, the ripple spreads east. Census and IRS migration data show that between 340,000 and 400,000 people per year have left California for other states since 2022. Texas, Arizona, and Nevada have become the main destinations. Phoenix, in particular, absorbs more than 20,000 new arrivals from California each year. The result: rents in Phoenix climbed nearly 6% year over year, double the national average. Apartment List and Zillow both confirm that the city's rent growth now ranks among the fastest in the country. Property managers and economists point to the same cause: steady inflows of Californians arriving with bigger budgets, outbidding locals for entry-level and mid-tier rentals. Austin and Las Vegas feel the pressure too. Austin rents jumped nearly 5% in the past year, while Las Vegas saw a 5.3% rise. Local housing officials and analysts trace these increases directly to the surge of California transplants. In each city, the story repeats. Families priced out of Los Angeles or Sacramento land in new markets, driving up demand and tightening vacancy rates. For longtime residents, the competition has made affordable rentals scarce and pushed monthly costs to new highs. Economists warn that if California's correction deepens, these interstate ripples could intensify. The migration pipeline remains wide open, and the cost gap between California and its neighbors keeps fueling demand. For Phoenix, Austin, and Las Vegas, the influx may be both a blessing and a threat. Growth brings opportunity, but also the risk of runaway rents and local backlash. The numbers from California now echo across the West, reshaping housing markets hundreds of miles from the original freeze. In May 2025, California's housing market reached 73,000 active listings, levels not seen in over a decade. This surge in unsold homes, combined with 63% of counties requiring more than a third of household income for housing, marks a clear shift from the boom years of 2020 to 2022. The withdrawal of major insurers like State Farm and Allstate, and the rise in average mortgage rates to 6.82%, have created barriers that stop deals in their tracks. While buyers and sellers wait, the data shows sales near record lows and prices sliding, with Zillow reporting a 0.42% month-over-month decline. Yet, it remains unclear how long these pressures will last or what will finally break the freeze. What is certain, based on multiple MLS and government reports, is that California's market has entered a new era, one defined not by bidding wars, but by hesitation and uncertainty.